Right, I'm going to talk for a little while about penalties now. I haven't really seen any of the real biggies being wheeled out in the context of ordinary investigation. All the penalties that one sees tend to be penalties related to careless inaccuracy. And it's not always the case, there have been some deliberate ones, but stats that I saw for the first year when they could have charged penalties under the section, 2008-9, I think 97% of the cases that they charged a penalty were penalties for careless inaccuracy. Now, there is no way in a million years that all the default cases they saw were the result of careless inaccuracy, but it's just what it was called. And of course, the reason for that is that they felt if they just had a sudden zooming upwards of penalties, there would be a public outcry. But now they obviously feel that, outcry or not, we've just got to go for it because the powers are there, and it's ridiculous to call a large percentage of investigations anything other than a deliberate inaccuracy of one kind or another. But of course, if Schedule 24 is going to become the order, it is the order of the day, it's not going to become it, it has been for years, what do we need to do? And the answer is that if the issue of deliberate inaccuracy is going to become a large one in investigation, we just have to grow some new skills, because this schedule, like so much of the Revenue's new compliance regime, is intensely focused on behaviour. And if it's intensely focused on behaviour, then it gives us an opportunity to moderate what we do, to put our clients in the best possible position. And there are PI issues attached to this, in my view, without any question. So it's a real important issue to get on top of it. And the sorts of issues are, for example, whether or how to describe behaviour. Most things can be described in one of a number of ways, and we have to become expert in analysing the facts of investigations to describe what has transpired as the result of carelessness rather than deliberate action, and to segment any potential settlement that we see into things that have been caused by careless action and deliberate action, because a lot hangs on this. There's not just penalty quantum. The maximum penalty for a careless inaccuracy is 30% of the tax in a prompted case. Okay? The maximum penalty for deliberate inaccuracy with no concealment, which is where the vast majority of ordinary investigations are going to end up, is 70%. Now, when you think, I was told by a serving member of Special Investigations that in the old days of blessed memory, the average penalty loading for a settlement of a fraud case involving a disclosure report that was accepted with no further action was 40. That was the target. We're now looking at something in ordinary investigations where 70% is going to be the maximum penalty exigible. And for deliberate inaccuracy with concealment, the maximum is 100%. So no change there, which it always has been, I suppose. But there is a step shift between the penalties for careless action and the penalties for deliberate action. So it becomes intensely important that we acquire the analytical and descriptive skills required to locate what your clients do in one box or the other, because it can cost an arm and a leg if you don't do it. There is also, of course, the point about suspension, which I'm going to talk about later briefly. Only penalties for careless inaccuracies can be suspended. But suspension is a very, very widely available power and can mean that your client ends up paying no penalty at all. So again, very important to be able to describe and identify careless behaviour. Time limits, there's another thing. Used to be the case in the old days that whether or not you've been negligent or fraudulent, the Revenue can go back 20 years to assess. Well, not anymore. Nowadays, of course, there are in fact 3 different time limits. If there is an error which is not attributable to a failure to take reasonable care, and there's just a mistake with no carelessness involved, you've done your best and all the rest of it, then they've only got 4 years to assess you. If it is careless, they can only go back 6 years to assess, or they have to assess within 6 years, and if it's deliberate, then it's 20. So again, it becomes critically important to make sure that you understand what this means. And of course, there is also the massive stressful botheration of managing deliberate defaulters or serious defaulters policy that the Revenue have instituted, which basically, if you commit a deliberate inaccuracy, the Revenue are on your case for a number of years afterwards, making your life more or less a misery. So there are very good reasons why you need to be able to identify that sort of distinction. The other point, which we'll look at in a second, is you need to be aware of what the difference is between a prompted and an unprompted disclosure, because it's not what you think it is. And then there is the issue about managing disclosure generally in the context of investigations, because, as again, I'll give you an example to show you, the difference can be enormous, and the penalties can be, savagely large. So, there we go. One of the differences, or the principal difference actually, between this regime and the last, is that in the old days, the maximum penalty was 100, and then you would negotiate a sensible answer with your revenue officer by consent, if you like, to take it down to whatever the normative penalty was. So in ordinary investigations, between 15 and 25%, usually say 20% on average. Those days are gone, because now we have a statutory minimum penalty, beneath which level, regardless of the quality of your disclosure, the penalties cannot fall. And here you see what the real difference is between prompted and unprompted disclosure, because if you have a careless inaccuracy, you might, if your disclosure is at a phenomenally high rate, be able to get your penalty down to 0, which is great news. But if it's a prompted disclosure, the best you can do is 15%. Now, in a deliberate and unconcealed case, which, as I say, is the sort of run-of-the-mill investigation penalty, unprompted disclosure, best you can do is 20%, so there's some parity there with how things used to be. A prompted disclosure, 35% of the tax is the best that you can do. And for deliberate and concealed action, and to give you an idea, you might think, well, yes, okay, if you have an offshore bank account in your dog's name, and that is obviously deliberate and concealed, and so you deserve a high penalty. But when you look at the Revenues Compliance Handbook, and I urge you to have a look at it, you will see that one of the things that they describe as deliberate inaccuracy with concealment is concealing entertaining expenditure under a different heading and not having it back. So, quite how that's at all like hiding your money in an offshore bank account under a false name, I don't know. But the categories seem to be extremely broad. Okay, teaming and lading is seen as that as well. And there we're looking for an unprompted disclosure. When we're talking about deliberate inaccuracy in human behaviour, how many deliberate defaulters are actually going to disclose in an unprompted way? 30% are unprompted, but for a prompted disclosure, the best you can do is 50% of the tax. And if it's in a slightly dodgy category, those penalties are increased by 50%. And if it's in a very dodgy country that you fall your misdemeanors associated with, it ramps it up to by 100%. So we have a statutory minimum 100% penalty available, and maximum, of course, 200% penalty for those whose misdemeanors relate to a Category 3 country, basically one without any information exchange provisions with the UK under tax treaties. So this is a very, very different ballgame. And you can, of course, the question becomes, how on earth do you get your penalties down to the statutory minimum? Okay? Well, and indeed, how do you make sure it's unprompted or prompted? Well, there are statutory definitions for all of this stuff. A disclosure is only unprompted, in other words, it's only tolerably affordable, if there is no reason to believe that the revenue have either discovered the problem or are about to discover it. Okay? And what that means in the revenue's view, and I think they're right, is that once they have written to you and said, we'd like to do a compliance check on your client, it's too late to go, oh, I was just about to mention this thing that I have done. That's a prompted disclosure. Unprompted disclosure really does mean telling the revenue about it before it's even a twinkle in their eye. All of a sudden, there is a financial incentive written into the statute for voluntary disclosure, a completely new thing. But when you look at the size of the penalties for prompted disclosure, it's at least something that should be floated past clients as a possibility if there is anything that they need to say. Failing to do so, I think, leaves you liable. And So having decided which of the two tracks you fall into, unprompted or prompted, you know what the minima are. You then have to try and, but you don't know where you are between the maximum and the minimum until you've sorted your disclosure out. And so therefore, how do you do it? Well, again, the statute sets out the criteria for reducing, not mitigating, but reducing penalties under the new legislation. And the three ways you can do it are by telling the revenue about it, by helping the revenue with it, and by giving access to them during the course of the investigation. But even in these cases, if you want to avail yourself of the maximum reduction, then you need to think real hard about exactly what you're going to do. Because have a look in the compliance manual and see what the revenue expect. Telling the revenue about it, it's not a case of the revenue saying, you've been hiding your money under the mattress, haven't you? And you go, yeah, I have, yeah. That's not telling the revenue about it. What they want to hear is not just an admission, but a full disclosure of everything that has happened and an explanation of how you did it and why you did it. Why? How on earth are you going to, why have you put that money under your mattress? Well, I'm just dishonest. How on earth? But, it does beg a question. You can't be saying, well, it's an accident. But you know that this is the kind of question you're going to get. And you will all have had records, letters from the revenue, on sometimes quite mundane matters, a long way away from mainstream investigation, where they say, well, this might be the case, why did your client do this? And they're really interested in behaviour nowadays. And this is why, it's all to do with penalties. And so, from our perspective, we have to be right on the front foot with getting ready to describe what is done, being able to tell our clients what they need to say. Holding out, if you know there's a problem, is just a month's game. It's going to cost you a fortune. What about helping? Well, again, this is all to do really more with your input. Are you going to help the revenue quantify the amount of any additions? Are you going to reply in a timely way to letters? All this kind of stuff. That's what helping the revenue is all about. And giving access. Once again, this is all to do with records. And if you make a full voluntary submission of all your records, business and private, then you're going to be fine. But if you whack out if they have to issue a notice, an information notice, then you're not going to score your maximum bit. And this is how the revenue attribute reduction, 30, 40, 30. So let's see how this works in practice, okay? We've got telling. Well, your client is just an ordinary investigation, a taxi driver, and he's not been declaring all his cash, he's just been taking some, not telling you, not telling the revenue, and he's admitted it all now. But initially, he denied it all. But then when the evidence became too mounted up against him, then he finally did spill the beans and did the kind of telling that the revenue were expecting. So initial denial, then a full confession, so he gets 20% off. Okay? So helping. Well, you could have done better. You didn't help them quantify the additions, very tardy initially replying to correspondence, but as you realised it was a bit of a hopeless case, you became a load more helpful. So you get 20 for that as well. Okay? And then giving access, 30% possible maximum. Well, he was fine with his business records. He gave him the entire lot, and then they said, let's see a private bank account. And he said, well, no, you're not having that. And so they issued an information notice by return of post, as is likely to be the won't. So you get 20% for that. So you've got a 60% reduction. Now, this is deliberate inaccuracy with no concealment, traditional investigation. Okay, maximum penalty 70. You think reduce it by 60% is 28. So you think it's going to be 35% because that's a statutory minimum. You can't actually do it better. Well, it's not quite that simple because this is the way that it works. You've got your disclosure percentage of 60%. But the amount that is available to reduce the penalty is only the difference between the maximum and the minimum. And so what you do is, you do 60% of 35, which is 21, and you deduct that from the maximum to give yourself a penalty of 49% of the tax. In a very small case, in circumstances which are bog standard ordinary in the course of a normal investigation. When you see huge penalties like this coming into play, you suddenly start to realise why it's so important to manage disclosure in an expert and focused way in order not to have your client ending up paying penalties of this kind of quantum when previously, under the old regime, you might have been paying 20. It's a completely new world, and our behaviour just has to change if we're going to be able to do a properly good job for our clients. It's not all bad news. If you are able to argue, as you certainly should be arguing, that the case that your client's involved in is one that involves careless error, then you should be able to get the penalty suspended. And slowly, initially when suspension started being a sort of matter of debate, the Revenue's approach to it was, basically they were looking for reasons not to suspend penalties. The tide seems to be turning with that, and I think that's correct, because in the context of this rather sort of dark piece of legislation, this is an intensely, liberal piece of legislation. What it basically says is that for people who commit careless mistakes, Parliament reckons it's a fair trade to give up their penalty if they can show that they can satisfy conditions which mean not that they will never commit a careless inaccuracy again, because of course you can't ever promise that, careless inaccuracies are accidental. So not that they will never commit another careless inaccuracy, but that the chance of them doing so again in the future reduces. And so I wrote an article about this about 18 months ago in Tolley's Practical Tax, and before I sent it in, I ran it past the Revenue's policy guy who runs suspension, and he agreed with most of it, not all of it, most of it. But the one thing that he said was absolutely essential, he was glad that I was saying it, is that advisors need to take a role in formulating the conditions that taxpayers have to satisfy in order to achieve suspension. And that is a really worthwhile thing to do, and it's also something that clients really like. I mean, I've seen penalties suspended in cases that I've worked where the penalty has been sort of 15 grand, 18, 20 grand, large amounts of money, where it was a careless inaccuracy. One of the most common reasons or conditions that I've set that seems now to be generally accepted following a case recently before the first tier, where that was actually recommended by the judge as a course of action, is many careless inaccuracies arise at the tax return submission time. And what happens is that the returns get sent out to clients to sort of approve submission, and they don't really look at them all that hard. They just sort of go, yeah, go on, send it in. And they don't realise that something has been missed off, often in the accountant's office. And in fact, in the two cases I've just mentioned, it was. And so I said, and initially we said, right, we apply for suspension. And the Revenue said, no, there are no conditions which will make it more likely that you won't do this in the future. So I sort of said, well, yes, there is one. What you can do is, he will undertake to come in and not just do the submission process remotely, he will come in and have a meeting with the partner, go over the return with the underlying documentation so that both parties are happy with what is going in. And that would, in those cases, probably have stopped the error in its tracks. It would never have happened. But in any case, it is obviously going to reduce the likelihood of a similar error occurring. And even though it was turned down initially, I resubmitted it for internal review, and they accepted it at that stage, and the next one was accepted far more readily. This can be done, and again, when you're talking about a penalty regime which is as aggressive as the one that we've now got, it is really important to make sure that managing or dealing with and operating the suspension provisions, it's paragraph 14 of Schedule 24, you've got to be right on top of it. In another context, don't forget ADR. This again is something I was involved in formulating with the Revenue, and it is a fantastic facility. I'm not sure, have any of you actually tried it? Alternative dispute resolution. The Revenue's version of it. Have you? What was your experience?
Very good.
Yeah. I mean, that seems to be the general experience. In the pilot, which ran for the thick end of 2 years, they did 350 cases. The initial tranche of those, which was about 200, they took them from cases that were up for internal review. So in other words, these were cases that were already appealed. In other words, all the argument was over. The next stop was the tribunal. Everyone was at loggerheads. And in those cases, 60% of them resolved to the satisfaction of both sides. And the strike rate has been similarly impressive since they sort of opened it more widely to non-appeal cases as well. So this is a really good facility, and some people are put off it because the facilitators in these dispute resolution cases are revenue people. They are specially trained in mediation techniques, and they sort of basically shuffle between the two sides in order to broker a deal. They are selected so they have no previous knowledge of the case, no previous working association with the caseworker, not from the same areas usually, so they do their best. And in all of the cases that have so far gone through, in not one single case was there a complaint of bias from either side, in fact, which means that they are doing a fantastically good job. And if you are, and in investigations in particular are very sort of fact-based, and so they are the kinds of circumstances which are very amenable to mediation generally. If you do find that negotiations run into the sand, or you're just talking to the hand the whole time, they won't listen to what you say, sign up for ADR, because you will get somebody coming in and, in a large number of cases, just saying to the caseworker, look, this is not what the law says, move on and sort it out. So it is a really good way of cutting the Gordian knots that you so often come across. And you don't have to wait till the end. You can do this mid-stream, in the middle of an investigation, or whatever it might be. It is a phenomenal resource. I cannot recommend it highly enough. When you get these opportunities, you need to take them.